In this video, we'll go through Tesla's Q4 numbers. We'll look at what's improving, what's getting worse, and how Tesla's long-term strategy around autonomy and AI could impact the stock. And by the end, we'll talk about whether Tesla makes sense as a buy right now, or if investors should stay cautious. Tesla's Q4 numbers show a mixed but important picture. In the fourth quarter of 2025, Tesla generated $24.9 billion in revenue, down about 3% year-over-year. Automotive revenue declined 11% to $17.7 billion, reflecting lower vehicle deliveries and ongoing pricing pressure. At the same time, Tesla's non-automotive businesses continued to grow. Energy generation and storage revenue increased 25% to $3.8 billion, while services and other revenue grew 18% to $3.4 billion, showing Tesla is becoming less dependent on vehicle sales alone. Profitability improved despite lower volumes. Total gross margin reached 20.1% in Q4, the highest level in more than 2 years, even with lower factory utilization and higher tariff costs. Operating income was $1.4 billion, though operating margins remained under pressure due to higher spending on AI, autonomy, robotics, and stock-based compensation. From a cash perspective, Tesla generated $3.8 billion in operating cash flow and $1.4 billion in free cash flow. The company ended the quarter with $44 billion in cash and investments, giving it significant flexibility to fund future growth. Overall, while automotive revenue is under pressure, margins and cash flow are holding up as Tesla continues shifting toward energy, software, and long-term investments. Operationally, Q4 shows clear pressure on vehicle volumes, which you can see directly on the chart. Total production declined 5% year-over-year to 434,000 vehicles, while deliveries fell 16% to 418,000 units. The steepest decline came from Tesla's lower volume models, reflecting a deliberate wind-down of legacy platforms, rather than a sudden collapse in demand. Model 3 and Model Y volumes declined more modestly, while Tesla's installed base continued to grow. Cumulative vehicle deliveries reached nearly 9 million vehicles, which matters less for near-term car sales and more for software, services, and autonomy-related revenue over time. Full self-driving adoption also continued to expand. Active FSD subscriptions reached 1.1 million in Q4, up 38% year-over-year, supporting Tesla's shift toward recurring software revenue, even if it creates short-term pressure on margins. Inventory remained controlled at around 15 days of supply, while energy storage deployments reached a record 14.2 gigawatt-hours, up 29% year-over-year, reinforcing energy as a key growth driver. After the numbers, the biggest focus of the earnings call was Tesla's Robotaxi business. Tesla said it now has more than 500 robotaxi vehicles operating between Austin and the Bay Area, including paid rides with no safety driver in the vehicle. Management described the rollout as cautious but accelerating, with expansion expected city by city as regulatory approval allows. Tesla emphasized that robotaxi is no longer just a future concept. The company is already learning how to scale charging, service, and fleet management using its existing infrastructure, which it believes provides a major competitive advantage. Elon Musk also stated that robotaxi deployment is growing on an exponential curve, with the fleet potentially doubling on a monthly basis from a small starting point. To scale this business long-term, Tesla is developing CyberCab, a dedicated vehicle designed specifically for autonomous ride-hailing. Unlike Tesla's current cars, CyberCab has no steering wheel or pedals and is built purely for autonomous operation. Tesla expects CyberCab production to begin in April, with an initial slow ramp before scaling over time. Management emphasized that CyberCab is designed to minimize cost per mile rather than maximize driver comfort, using a compact two-seat design optimized for high utilization and durability. Over the long term, Tesla expects CyberCab to become its highest volume vehicle, exceeding the combined production of all other models, and serving as the primary vehicle for the robotaxi network. Tesla is also intentionally moving away from legacy cars. Elon Musk confirmed that Tesla plans to wind down and effectively stop production of Model S and Model X next quarter. Rather than replacing them with new premium consumer vehicles, Tesla plans to repurpose that factory capacity toward robotics and autonomy. This strategic shift explains the sharp decline in production and deliveries of Tesla's lower-volume models. Full self-driving was another major focus of the call. Tesla confirmed that it is transitioning FSD fully to a subscription-based model, creating short-term pressure on automotive margins while improving long-term recurring revenue potential. Tesla continues to frame FSD as a core pillar of its autonomy strategy, supporting both Robotaxi and future software-driven revenue streams. Optimus represents Tesla's longest-term and most ambitious bet. Elon Musk confirmed plans to convert the Model S and X production space in Fremont into an Optimus robot factory, with a long-term goal of producing up to 1 million humanoid robots per year. At the same time, Tesla was clear that Optimus remains in the early stages and will not contribute meaningful revenue in the near term. Management expects a slower production ramp due to a completely new supply chain and advanced AI requirements, viewing Optimus as a long-duration opportunity tied to labor automation rather than a short-term earnings driver. When you look strictly at the numbers Tesla is reporting today, the stock looks overvalued. Revenue growth is slowing, vehicle volumes are under pressure, and a large part of the valuation is based on future expectations rather than current earnings. If Tesla were judged only on its present-day automotive and energy results, the valuation would be difficult to justify. But Tesla is not being valued on today's business alone. The stock reflects what could happen if robotaxi scales, if full self-driving becomes truly autonomous and widely adopted, and if Optimus evolves into a meaningful platform for labor automation. If those pieces come together, Tesla's future earnings power could look very different from what the numbers show today. Ultimately, whether Tesla is a buy comes down to belief. If you don't believe in Robotaxi, FSD, or Optimus, Tesla likely looks overvalued. If you do believe in that vision, and you believe Elon Musk can execute on it, then Tesla may still be undervalued despite how the current earnings look. Investing in Tesla is less about today's balance sheet, and more about whether the future Tesla is building actually arrives.